the consumer, Matt.
All right. Yeah.
What's going on with the consumer?
This Reuters report showed weaker jobs data, and this was after last month showed stronger than expected jobs data. This is one data point among many that we'll cover here in a couple minutes that suggests that we could be approaching an inflection point for inflation. Job gains were a little low, and wage growth, while still elevated above historical norms of around 3.5%, is down slightly. So wage growth moved from 4.1% to 3.9%, and unemployment is up from 3.8 to 3.9. Small movements, but still things are not moving towards overheating. They're moving in the other direction. These are two big things that the Fed watches: wage growth and jobs. Their mandates are, jobs and inflation, and I'm sure that they're looking at this maybe with a sigh of relief. Maybe they're thinking something different. Although it's not dramatic enough to convince him to do anything.
True, but I think that it follows the Fed's narrative that things are slowing down. Inflation is cooling. We've had a couple bumps in the road, but generally we think we're we're on this glide path down to whatever type of landing that we're going to call it. And you brought it up. You mentioned the right point, Matt, is the balance between this dual mandate of stable prices and maximizing employment, stable employment, and they have to weigh what is the bigger risk to how they're going to lean in on their policy decisions. Yeah. And the labor market has been so hot that it's not even a question of does the Fed need to step in and support the labor market. Okay, so that's not the labor market's not a concern. The other mandate, stable prices, aka inflation, that is the concern. So, they're not going to come off of higher interest rates, which the goal is to reduce inflation by weakening the labor market. They're not going to reduce those rates, when they're seeing that the labor market is performing really well. There's no reason to. They have to see some signs that there's some labor market deterioration and that inflation is moving generally in the right direction so they can shift their balance of risks and focus. Yeah. And so this is opening up the door to, I think, start having those conversations of, okay, maybe we ease off on focusing on stable prices and we need to make sure that we're balancing to make sure that we don't kill the labor market over time.
Yeah. Even if they didn't have, if their sole mandate was inflation without respect to jobs, if they were looking for signs that it was lowering, that they were doing a good job rather than threatening to do a bad job, with recession. Yeah. If they were just looking at the jobs, they were all, or inflation, I'm sorry, jobs is one thing, jobs a little cooler than possible. And then there's a couple other things that that we can talk about here in a second, but credit, it's also kind of cooling in a way. And savings also, people are depleting their savings as well. Yeah. So if you're looking for reasons why people are going to see an expensive value meal at McDonald's and say, no, I'm not gonna buy it today. It's too expensive. Yeah. Those things, your job doesn't pay, or you don't have the job, or there are less jobs out there. There's less credit out there, or people are taking out less credit. There's all these signs that maybe people are deciding or have the conditions that will enable them to say no to more expensive things. Yeah. These are just ingredients, and this next week's CPI report could tell me something different, but I think that this would still be valid even if there was a little bump up. I still would think, given this evidence that we're seeing in just the past week, things could cool down in the future, in the months to come.
Yeah, and I think very quickly we could see the shift from a concern over cooling. In so many of the areas of the economy are still going strong, but I mean, recession or manufacturing has cooled off a little bit recently. Again, wage growth, while wage growth is still outpacing inflation, but it is moderating as inflation is moderating. And again, the concern was this wage price spiral. If wages kept being increased, and then prices have to be increased, and then it's a chicken and the egg between the two. Yeah. So we're seeing less evidence that we're getting in that type of scenario. Yeah. And so then again, the base case hasn't really changed, at least for me. Is I see evidence for elevated growth rates, like maybe a little bit above 2%, or maybe, I don't know, since we've been below 2% the last decade, maybe we're at 2% or a little bit above. I think it's gonna be elevated for inflation.
For inflation,
yeah. But I don't see the driver in the narrative that would contribute to the the runaway, the hyper,
like a feedback loop,
or like when I hear someone today say, interest rates could go much higher. It's like you do have to be prepared for that. That's a smart thing to be aware of. But I just don't see it. I don't see the path. I mean, a lot of suggestions that we could make. Just was like I see a path to near zero rates. Like I can paint you that path.
Yeah. And these are not new movements too. I think the path is, this graph just shows here, average earnings were up 5.9% year over year in March of 2022. That was kind of the peak. And then they've gone down all the way now to 3.9%. Now, if you're looking at for kind of like a pre-pandemic average, it does look like 3.5% is like the generous.
And this is rate of growth.
Yes, this is average rate of growth.
I'm just clarifying. So we're still growing, at above, just below a 4%, rate of change.
Wages, that's a pretty good wage bump.
And if inflation's really just above, 2% right now if you strip, the housing out of CPI. I mean, that's wages are almost double inflation.
And that's the other set of numbers that I didn't include here is rents. There was a bunch of articles that were like rents haven't even been really reflected in inflation, and we should be ready for this deflationary effect of lower rents.
What do you think is going to happen when that happens, Matt? And when like a CPI print that ever comes in that says rents have just fallen off, it'll be in the same period where rents actually are increasing.
I'm sure. For sure, almost positive.
And so then what are our reaction?
Well,
I'm just anticipating our reaction of just bang our head against the wall because that's what we see these CPI prints come out and the market's reaction of we're in this hyperinflationary environment because of rents, and we're looking at all of the data and just direct experience being like, no, rents and almost everywhere in the country. I know. Yeah. I don't. Yeah.
Don't make us look bad.
Well, technically, if you actually break down the components of CPI, 36% that makes up shelter. Yeah. It's not the greatest dinner party conversation. Even now that I'm thinking about it, I definitely have been that dinner party guest that's talking about CPI.
Oh, for sure. Every weekend for me.
Like, well.
CoStar researcher, I'm going to get on the show. We'll get a CPI person from the Bureau of Labor Statistics.
Are they picking up the phone?
Well, I am a Facebook friend with him, or not Facebook, LinkedIn connection.
Bureau?
LinkedIn connection
with the whole bureau, or just with a guy?
It's close. It's one guy, but
that's all you need is one.
Yeah.
He's gonna be your in.
Yeah, he's my in.
You can have a mole.
I'm not gonna abuse my LinkedIn connection, but I will send him a couple messages.
Yeah, there's no insider trading, right?
No way.
This is just got a guy at the BLS. You know that. So viewers, the market can know.
And what is he going to tell me that we don't already know?
Well, just unnamed sources. Unnamed sources at the BLS. Just keep them unnamed.
Yeah. All right. Got it.
Okay. No, who was I was talking to their fiance or husband was working at the Federal Reserve in St. Louis, and I'm like, oh.
So
can we get some details?
Yeah.
And they were like, he doesn't know anything. I'm like, no. I'm like, well, it doesn't seem like anybody knows anything anywhere.
Can you turn the dial down? I'm sure it's somewhere in the building.
Can he make a suggestion about how to calculate CPI?
Raise his hand during a meeting.
Yeah, they know. And they're like, we know. We're not.
My friend's fiance told me this. Oh, that's funny.
Yeah. All right, but so consumer credit oozes up 0.4%. Matt, is that anything to worry about, or it doesn't seem that?
No, I think it's a little bit of a misleading headline, a little bit of a bury the lead kind of situation. What's really noteworthy is that this consumer credit grew much more slowly than expected. The quote here that they really should have put in the headline is, after bumping up a revised $8.4 billion in March, analysts had expected a larger $14 billion April increase, but the actual number was $11.1 billion, which again is less than expected. So consumer credit is actually slowing. And there are, we can look at the different charts that show this, whether it's revolving credit or all consumer credit or all private credit. There's a bunch of these figures that, because I was a little unsure. There's a lot of different terminologies when it comes to these credit measurements. But what I did notice is if you're measuring it based on year over year change, all of these measures of credit show a consistent decrease from around like third quarter 2022 till now. And again, even in this article alone, if you're not even looking at kind of the longer trends, that's like a 20 to 25% below the line.
Yeah.
So it's not only less than imagined, but it's significantly less than imagined. And I think we were talking about this before. A lot of people talk about credit as it's never been higher before, but like credit's always increasing. Unfortunately, it's always increasing. It's always going to be higher than it's ever been before. That is just like the population. Tomorrow I'll have a headline there that says, there's more people around, of course. There's
or the national debt, which is a problem, but yeah, exactly.
And notwithstanding like the headline about oozing up, it does that Motley Fool article does give a nice breakdown of what these different terms mean. Not like a perfect one, but it does talk about how revolving credit is like credit cards, and that has remained erratic with minimal 1% annual gains. At the same time, non-revolving credit, which is fixed installments like car payments, has carried credit increases with a 6.4% annual gain. For April, revolving credit fell an annual $10.9 billion. So that means a quick reaction, right?
Yeah.
I'm not taking credit cards, compared with a $111.3 billion positive flow for non-revolving credit. So these big purchases people are still making, or they have to make. I mean, sometimes you got to have a car, you got to have a house. But maybe the shorter term, am I going to get that $10 value meal at McDonald's? No, it's too expensive. I'm not going to use a credit card.
It's interesting.
That's my anecdotal explanation.
Because, and this is different from, I think, some of the data that, we've seen maybe last year and that gets talked about a lot. That's, showing, like, as you mentioned, just, there's a record of consumer debt out there right now, and the consumer, is loaded up with credit card payments. So it sounds like your argument to that, but I think a lot of people might say, yeah, I've seen the article, and consumers are, they're squeezed right now, they're up to their eyeballs in debt. And you're saying is like, the consumers have, some debt, right? Quite a bit of debt.
Yeah.
But they're adding to that debt at a much slower pace.
Correct. Yeah.
And that's a good thing. We're trending in the right direction.
Yeah. Yeah.
And so we don't necessarily just need to look at the aggregate total amount that everyone's has already owed, because again, a lot of, it's that often sometimes gets removed and destroyed, but a lot of times it gets rolled over. It doesn't always get paid off. It kind of, a lot of times you roll it. You maybe pay off your credit card, but you're going to put some more money on your credit card. So you're paying it off, you're putting it back on, but you're putting a little bit less on it.
And think about it this way: if revolving credit only went up 1%, whereas inflation went up 3.8 or 3.5%,
that's true.
Then you are getting kind of a positive effect. So that's great. It's great that people aren't getting into debt as steeply, although it's not erasing it, but it's still it's good to see that.
Again, this is the revolving consumer credit owned and securitized. I mean, we certainly were at this really high peak of growing 15% year over year back in, I think it's 2023, Matt, and I think that's when a lot of these articles really started coming out. Yeah, it's January 2023. But we are, coming down off of this, which is a really good sign.
Yeah.
Maybe this is, inflation reducing. It kind of lines up with that period. Seeing inflation starting to really kind of take a back seat. But we still are at elevated levels of growth, Matt. Again, on credit card, percent change from a year ago, we've grown 7.8%. I mean, we really do have to go back almost to before the great financial crisis until we've been at a similar spot, other than as post COVID. Obviously we went from we shot down. Everyone got their stimmies and paid off their credit card or stopped using their credit card for whatever reason, and then it shot back up, which is all just, again, fascinating to have lived through.
Yeah. Well, and if you want to talk about that is a really great segue to this article from the Federal Reserve Bank of San Francisco. What happened during the pandemic? Where's all that money?
Where did it go, man?
There it is. Well, I don't know where it went. I know that it went. That's the headline there. Pandemic savings are gone. What's next for U.S. consumers? In August,
the government helicoptered money and...
Well,
Made it
We made sure to
disappear.
spend it.
Where'd all the money go?
I'm good at
Look how that happened. How I mean, again,
Strange.
it's like the sugar rush. It's like
Yeah.
candy, good, and then
And-
I am still hungry. There was no nutrients.
And I'm hoping, and just like this article from, and this is kind of a informal blog post from the Federal Reserve Bank of San Francisco, but I mean, it's pretty formal. It's from the Fed.
As formal as the Fed gets.
Yeah, exactly. Well, but hopefully we will be getting more information on how much did stimulus affect inflation? What was the real cause? Because it's a little bit up in the air, but as we get more in distance, now we can kind of see, for example, in this study, it shows that in August 2021, pandemic total excess savings was peaking at $2.1 trillion. And now, March 2024, total excess savings is a negative $72 billion. Now, they define this as pandemic era excess savings, but that's the time period.
So what is that cumulative pandemic era excess savings?
Well, they define it right here. No, excess savings is calculated as the accumulated difference in actual de-annualized personalized savings and the trend implied by data for the 48 months leading up to the first month of the 2020 recession, as defined by the National Bureau of Economic Research. The stimmies, maybe. I mean, that was very. I felt like I was reading fine print there for a second, but my guess, it is the savings that accrued during the pandemic, and it is, well, now it's gone. I think that the most useful and
Well, it's more than gone. It's we've now gone into debt.
Yeah,
we're $72 billion.
And we're drawing on something that's not pandemic era savings, that's for sure.
And is this not, I guess, a little counter to, I guess, the data we were just looking at? The consumer credit is reducing.
You would think that. So what is, if
or yes, we're looking at savings, we're not looking at debt, but I'm just saying that if it's gone negative,
wouldn't you think savings is gone, credits less? People are using a credit card less, people's savings are less. Wouldn't that mean that the only possibility is in the spending less? But again, I'm sure I'm missing something big. I would know.
And not necessarily, I think they're spending more on essential things and, less elsewhere. And, again, it's the rent, food, utilities, gas in the car.
Yeah. Yeah. And if you look down the second chart here does talk about, so how much of a monthly change was it? So it was positive until maybe around that August of 2021, and then after that we started eating into our savings. So September we started eating, September 2021 all the way until March of 2024, which, and this is a little bit more worrying, is that we seem to be increasing the amount where we're eating into savings, far less than it was, or I'm sorry, a little bit more than it was in 2023. So I don't that's a little bit of, I can't square that circle as easily as saying, well, no, they're spending less. Well, no, they're kind of eating into savings, and there's a little bit of speculation on maybe the implications and what this might lead to from the Federal Reserve, although none of them are, they're just as satisfying as my, well, maybe they're spending less.
I wish there were more reports, Matt. I don't know if you can find some that really break this down relative to different kind of income demographics.
Yeah, that's
different
a good point.
different income, different quartiles of income, or however the breakdown is. Because I'm assuming there's, and because I'm saying this, seeing in our view of consumers from a property manager's perspective, and owning and managing properties that are both would classify as kind of workforce housing, a little bit more blue collar, rents in the $800 to $1,000 range, and then we've got apartments that are really more A-class lifestyle that rents are in the $1,200 to $2,000-ish range.
Yeah,
we've seen different behavior in terms of collections and just demand and occupancy and some different behavior, and just looking at how that's breaking down and who, because the wages are growing in the bottom quartile a little bit more than elsewhere, but inflation, that population is also much more sensitive to rising prices and inflationary pressures. So it's a I think that these broad studies, which are good for general information on the economy, making these macro decisions, but to me, it begs more questions of, some of the details and the nuances.
Well, and you can see, the credit and savings seem to, in some ways, contradict each other a little bit when you're throwing all these ingredients in. Sure, I grouped them all because they say cooling to me, but I'm sure I'm missing some things.
And then there's also a data and noise conversation also of what is actual information that's going to tell us something that's a real trend on things are going, and what is just noisy from other influences. Whether that is like the stimulus aren't really noise, the stimulus checks. They were more of like a signal, but like really kind of short term and not trend oriented.
Yeah.
So
but that's what I did.
Interest rates, added a lot of noise. And confusion.
Yeah. But that's what I did think was kind of compelling, at least, about the numbers that we got on jobs, whether it's unemployment or wage growth, and the stuff on credit that we were looking through is, well, these are long, multi-year. It's not like things are jumping up and down and really inconsequential or just hard to read. Yeah. We're seeing this trend, so it means something, and it definitely doesn't mean things are heating up. That's what I was talking to you before. I was like, well, I don't want to go outright and say that CPI is going to be weaker. I'm just saying, like, well, given this evidence, it's far more likely that these are cooling effects than ones that would heat up the economy.
Yeah.
Leave something in the comments. Show me where I'm missing so that I can prove future episodes and we can really track this. But it does. Yeah, I'm not seeing where inflation is going to even come from. Even energy prices aren't quite so bad. I think obviously geopolitical stuff is like the only thing that I can kind of see as this black swan. They'll fly by sometime.
But I do think consumer psychology has changed, because now the consumer is like back in the mode of being like, no, rates are going to be. I don't know if businesses all are, but some are. Some certainly will be. Mm-hmm. But I think more and more consumers are saying, hey, interest rates are going to be this high, and they could be this high. It could be higher. I think they're saying like, well, look, never thought it would be like this. How bad? I mean, just think of the last 4 years. We had between pandemic and lockdowns and turmoil of all different kinds. I think people are prepared. Nothing phases us anymore. It's like, sure, 10% interest rates, whatever.